Welcome to the Deep Dive, the show where we take, well, a whole stack of sources, research papers, data, and we try to boil it all down into the essential insights, the things you really need to know to be well informed.
Yeah, cutting through the noise.
Exactly. And today, we're going to dig into a question that, honestly, it touches pretty much every part of our lives, doesn't it? From, the daily grind, paying the bills, to the really big sweep of history.
It really does.
Why does wealth often seem to concentrate? Why does it end up in fewer and fewer hands? And maybe more importantly, what does that mean for our societies?
Huge implications.
Just think about, say, Hong Kong. We're looking at research calling its top wealth concentration at the very top internationally. I mean, that's really something.
It's quite stark when you see the comparisons.
Or, Mainland China.
Yeah.
A whole nation that in just a few decades saw its national wealth income ratio literally doubled.
An incredible transformation.
Yeah. And these aren't just like abstract numbers on a spreadsheet, right?
Right.
They represent these huge seismic shifts in how wealth gets created, how it's shared out or not shared out
Yeah.
among us. And maybe even how our societies are kind of held together.
Yeah, the social fabric itself.
So our mission today, it's really for you, our listener. We know you're curious. You want to get beyond the headlines. We're going to try and unpack these powerful forces shaping economic inequality.
Mm-hmm.
We'll take you through some pretty groundbreaking economic theory first, but then, crucially, we'll dive straight into some fascinating real-world case studies, some really dynamic economies.
Yeah, bringing the theory to life.
Our starting point, our foundation for this deep dive, has to be that huge 2013 book by the French economist Thomas Piketty, Capital in the 21st Century.
Ah, yes, the book that launched 1,000 debates.
Exactly. It wasn't just a book, was it? It felt like a phenomenon. It really kicked off a global conversation about wealth, about inequality, changed how economists, and honestly the public too, looked at economic history and maybe its future.
Absolutely. It set the terms for a lot of the discussion we still have today.
But we're not stopping there. We'll then zoom in on two of Piketty's more recent papers. These ones co-authored with Li Yang. And these are super focused. They look with incredible detail at the dramatic rise of inequality in Hong Kong. That's from 1981 to 2020.
A really specific time frame.
And then Mainland China from 1978 to 2015. Again, tracking that massive transformation.
Two incredibly important case studies.
So our goal really is to pull out the most important insights, find those surprising facts maybe, and help you connect the dots, between these big economic ideas and what they actually mean on the ground for people's lives, for politics, in these really key regions.
Making those connections is crucial.
Okay, let's unpack this fascinating journey then into the world of wealth, how it gets distributed, starting with that book that really, really shook things up.
Right. Piketty's Capital in the 21st Century, it really was an immediate sensation when it came out. It was quickly called, I think, an authoritative guide for understanding where modern inequality was heading.
High praise.
Definitely. Some even said it powerfully argued that this rising wealth inequality actually imperils the very future of capitalism. That's quite a claim.
Wow, that's fundamental.
And the core idea, the thing that really sparked all that debate, it centers on this simple-looking but pretty profound inequality he presented, RG.
Right, RG. So R is the rate of return on capital, and G is the economic growth rate. R is bigger than G. But, okay, for someone maybe not swimming in economic terms every day, what does that actually mean? Like, for me, for you listening.
Yeah, that's the key question, isn't it? What does it translate to? Essentially, Piketty argued that wealth that's already been accumulated, what economists call capital, things like inherited fortunes, real estate, stocks, bonds, businesses.
Stuff that makes money on its own, basically.
Exactly. That stuff tends to grow faster. Its rate of return tends to be higher than the growth rate of the overall economy itself. And the overall economy includes things like average wages, salaries, labor income.
Okay, so money makes money faster than people make money just by working.
Yeah.
Is that too simple?
That's a pretty good way to put it, actually. Imagine maybe two families starting out. Let's say one inherits or maybe made some really smart early investments, and they have a decent chunk of capital, say $1 million, and it's invested, earning them, let's say, a 5% return each year. That's their R.
Okay.
Now imagine another family starting with pretty much nothing inherited. They work hard, their income grows, but it grows basically at the same rate as the whole economy. And Piketty suggests that might only be maybe 2% per year. That's their G.
Right. 5% versus 2%.
Exactly. If R, that 5% return on capital, is consistently significantly greater than G, that 2% economic growth, then the first family's wealth just compounds faster and faster. It's like a snowball rolling downhill, getting bigger all the time.
While the other family is, I guess, just walking down the hill?
Sort of, yeah. They're moving forward, their income is growing, but they just can't keep pace with the snowball, so that gap between them widens over time. And Piketty predicted that if this process goes on, unchecked for generations, well, economies naturally become more and more dominated by capital and by the people who own it and inherit it, leading to potentially extreme wealth concentration. He painted this picture, some critics called it a dystopian forecast, where society might start looking a bit like, the Gilded Age or maybe even those Jane Austen novels, where you have a leisure class, rentiers, just living off their inherited wealth while most people rely on labor income that grows much slower.
And that simple formula, RAG, it definitely hit a nerve.
Oh.
But it wasn't without its challenges, right? Especially around the data Piketty used. I remember the headlines, particularly from the Financial Times, claiming unexplained errors in his spreadsheets.
Oh, yes.
Especially about wealth inequality increases after the 1970s. It really reminded people of that Reinhardt and Rogoff controversy about debt data. Caused quite a stir.
It absolutely did. Chris Giles at the FT made those claims in May 2014. And yeah, the media ran with it. But it's really important to look at the context and Piketty's response.
What was his response?
He was remarkably transparent. He immediately put out a full point-by-point rebuttal on his website, addressed every single claim, made all his data public, spreadsheets and all, for anyone to check, which is, exactly what you want to see in academic debate.
Okay, so he didn't hide anything.
Not at all. And crucially, a lot of prominent economists, people like Scott Winship, Paul Krugman, Emmanuel Saez, who Giles had actually cited initially, they came to Piketty's defense.
What did they say?
They basically said, look, there might be some minor data entry mistakes, maybe some transcription errors here and there, but they weren't significant for the fundamental question of whether Piketty's thesis is right or not. Scott Winship put it quite well, saying it's hard to accuse someone of being unethical when they've made all their data completely open for scrutiny.
So the consensus, at least among many, was that the main findings still held.
Yes, the consensus among many economists was that the overall trend he identified, the rising share of capital, the increase in inequality remained robust, even if there were small quibbles about specific data points. The big picture wasn't really altered.
Okay, so the main thesis largely held up for many. But the debate wasn't just about potential errors, right? There were also different ways of looking at the data itself, alternative interpretations.
Exactly. It wasn't just about typos. Other researchers came along and said, well, if you measure things slightly differently, you get a somewhat different picture. For instance, Otten and Splinter looked specifically at pre-tax income inequality.
Before taxes are taken out.
Right. And they found that inequality did rise, but maybe less drastically than Piketty's initial figures suggested. Their estimate for the top 1% income share went from about 9% to 14% between the 70s and the 2010s. Piketty's comparable figures were more like 11% rising to 19%.
That's still a rise, but yeah, a noticeably smaller one. Why the difference?
Well, it largely came down to some subjective judgment calls in the analysis, particularly how you deal with missing income that doesn't get fully reported on tax returns for various reasons.
Like under-the-table stuff or just errors?
Could be various things. Otten and Splinter, based on audit studies, decided to attribute more of this missing income to lower earners. They also found tax non-compliance rates seemed higher for the bottom quintile. If you make those assumptions, it naturally makes the inequality curve look a bit flatter.
Interesting how those methodological choices make such a difference.
It really does, and it extends to measuring wealth, too. Take the argument from Sylvain Catherine and his co-authors. They looked at top wealth shares and argued they haven't changed that much over the last few decades if you properly account for Social Security.
Social Security? How is that wealth in the same way as owning stocks?
That's the interesting point. Their argument is that Social Security, while, yeah, you can't sell it, it represents a future stream of guaranteed income, a benefit. And functionally, that acts like a form of social wealth.
Okay, like an asset that pays out later.
Exactly. And when you factor that in, especially for the bottom 90% of people for whom Social Security is a huge part of their future economic security, it really changes the picture of wealth distribution. It boosts the wealth of lower and middle income groups, relatively speaking.
Making overall wealth inequality look less severe than if you just count, say, houses and stocks.
Precisely. So these different ways of defining income or wealth just highlight how incredibly complex measuring inequality actually is. Different methods, different assumptions can lead to quite different but potentially equally valid conclusions.
And beyond the data and how you measure it, there were also critiques aimed at the core model of capital Piketty used, right?
Yeah.
I remember reading some commentary, maybe from EconLib, arguing he saw capital as growing almost automatically.
Yes, that's a really fundamental critique getting into the philosophy of economics, really. The EconLib perspective, and others like it, argue that Piketty seems to view capital as sort of mechanically growing, almost like it just appears and expands on its own, without being significantly driven by human effort, things like entrepreneurship, risk-taking, innovation, management decisions.
So they felt he downplayed the human element in wealth creation.
That's the essence of it. They argue his portrayal suggests capital goods and services aren't really caused by or significantly affected by human agency. The inventors, the people who take risks starting businesses, the managers finding efficiencies. They felt his model made wealth seem like this sort of inevitable tide, not fully accounting for the sweat, the ingenuity, the effort that often goes into building value.
And what's the implication of that view, according to the critics?
Well, if you downplay that human agency, they argue, then large accumulations of wealth might start to look inherently unearned or unjustified. They pointed to Piketty's language, like calling tax cuts for the wealthy gifts to the rich, as evidence that he believed human effort played little role in creating or productively using that capital.
So they saw it as a misunderstanding of basic economics.
Essentially, yes. They argued it ignored fundamental concepts like scarcity and the need for incentives. If production were just automatic, why would we need to incentivize innovation? Why worry about allocating scarce resources? It challenges the very source and justification of wealth, shifting the debate from just measuring inequality to asking why wealth exists in the first place.
That's a deep critique. But here's where it gets really interesting. Because Piketty himself, like any good scholar, didn't just stick rigidly to his original formulation, did he? He evolved his thinking.
Exactly, and that's crucial. He later acknowledged that institutional changes and political shocks, things happening in the real world, policy decisions, major events, actually play a huge role, perhaps even more than just the RG dynamic, in explaining historical inequality trends and shaping the future.
So moving beyond just the formula.
Yes. In a 2015 article, he explicitly said that while his book traced history through that RG lens, he now emphasizes that institutional shifts and political shocks are often more powerful, more immediate drivers.
Like what kind of institutional changes?
Well, for instance, he attributed a big chunk of the rise in U.S. top income shares between 1980 and 2010 primarily to rising inequality and access to skills in higher education. That's a systemic institutional issue about opportunity, not just capital automatically growing.
Okay, so focus shifting towards education systems, access.
Right. Now, that specific claim also faced some methodological critiques. Some argued it didn't capture the whole picture, but it clearly shows his thinking shifting. He started recognizing more explicitly the impact of societal structures, deliberate policy choices, political action in shaping who gets what.
So it's not just an inevitable economic law, but something shaped by choices and events.
Precisely. He acknowledged that how inequality is structured can change really quickly, sometimes dramatically through things like wars or revolutions, but also through slower, maybe more peaceful institutional evolution, like the changes we saw in places like Sweden or the US over the 20th century. It shows how even the most influential ideas keep evolving as we get more data and new perspectives.
Which really broadens the discussion way beyond just RG. It brings in real-world factors, policies. And speaking of specific factors, one of the really surprising counterpoints that emerged focused on the role of, believe it or not, housing capital.
Ah, yes, the housing question. This is fascinating because it connects a really abstract economic trend, that rising share of national income going to capital, to something incredibly concrete. The house or apartment you live in or wish you could afford.
Right. So how does housing fit into this inequality picture?
Well, Piketty observed that rising share of income going to capital. But a key critique, highlighted by economists like Johnny LaCava, pointed out something crucial. That rise seems to be almost entirely due to the growth of housing capital.
Wait, almost entirely housing, not factories, not stocks, but bricks and mortar.
Largely, yes, according to this research. The argument is that the big increase in the value of housing capital isn't primarily because of, capitalism and capitalist competition in the way we usually think about it, companies innovating or financial markets booming.
So what is driving it then?
The argument is government regulation.
Regulation.
Think about things like restrictive planning laws, strict land zoning, height restrictions, complex permit processes, maybe even historic preservation rules.
Yeah.
These aren't just minor hurdles. They create what researchers call induced delays or artificial bottlenecks.
They slow things down.
Exactly. They prevent the housing supply, the number of new homes being built, from responding properly when demand goes up. And basic economics tells you if demand rises but supply can't keep up, prices go
Up. Way up.
Precisely. These regulations effectively act like a high regulation tax on building new homes. It's a cost, an artificial scarcity imposed by the system itself, not just pure market forces.
Wow. Okay, that resonates.
Yeah.
You hear about zoning battles and building restrictions all the time in expensive cities. And you mentioned Hong Kong earlier as a key example of this.
Yeah.
How does that play out there?
Hong Kong is almost a perfect, if extreme, case study. It's world famous for its sky-high housing prices and constant shortages. The data shows this widening gap between house prices and the actual cost of construction.
How wide a gap are we talking?
Between 1979 and 1988, the gap was already significant, about 98%. But between 1988 and 2014, it ballooned to 170%.
Whoa. So prices became nearly triple the cost of building.
Something like that, yes. That huge jump over 2 decades shows supply just consistently failed to keep up with demand year after year. It suggests that even if developers wanted to build more, the regulatory system made it incredibly difficult and expensive to do so.
But what about the crony capitalism idea? The perception that the government and big developers are in cahoots in Hong Kong.
That's a common narrative, but this analysis flips it. It argues the causation is reversed. The complex, restrictive regulations many inherited from the British colonial era, and largely unchanged for decades, weren't actually created by the big developers to help themselves.
They were already there.
Yes. The developers, big or small, have to operate within those existing constraints. The issue isn't so much that developers rigged the rules, but that the rules themselves being complex, slow, maybe not designed for rapid population growth or demand surges, make it incredibly hard for the market to respond quickly.
So only the big players can navigate that system.
Essentially, yes. Only the developers with deep pockets, big legal teams, and a lot of patience can afford to pay that high regulation tax and actually get projects built. It naturally leads to a concentration in the property development industry.
The system itself favors the big guys.
That seems to be the consequence. The barriers to entry become too high for smaller firms. And the biggest societal consequence, these soaring housing prices become the main source of inequality and wealth.
Because property owners get richer and richer while everyone else struggles.
Exactly. And it's not just Hong Kong. This principle, the high regulation tax driving up housing costs, likely applies in many other cities and countries facing affordability crises. What starts as inequality in housing wealth, where owning property gives you a huge advantage, then gets passed down. It transmits to the next generation, turning into inequality in opportunities.
Just being born into a family that owns property in one of these cities gives you a massive leg up.
A huge, often unearned advantage. So what this means for you, listening, whether you're trying to buy, worried about rent, or just seeing headlines about real estate, it suggests maybe the biggest drivers of wealth inequality aren't just abstract market forces. They might be rooted in these long-standing policy choices, these regulatory structures that inadvertently create artificial scarcity, especially in housing. It kind of bakes inequality into the system.
Which leads us nicely into taking a closer look at Hong Kong specifically, through the lens of that Piketty and Yang 2022 paper. It really digs into that soaring inequality and the political tensions it seems to have fueled.
Right. And to really get Hong Kong's unique situation, you have to understand the political backdrop, especially after the 1997 handover to China. Beijing adopted this strategy that's been called political absorption of economics.
What does that mean?
Well, Deng Xiaoping famously talked about Hong Kong people governing Hong Kong, but in practice, that was interpreted very specifically. It meant governance by Hong Kong's wealthy business class, the bourgeoisie, not the wider working class.
So rule by the rich, essentially.
That was the practical effect, and arguably the intent. It was seen as a pragmatic way for Beijing to minimize political friction, keep the economy humming, by basically co-opting and empowering the existing business elite. Some have called it Pluto-communism, this blend of communist political control allied with powerful capitalist interests.
Designed for stability, but maybe not equality.
Exactly. Stability and loyalty from the elite were prioritized. But it came with social costs, as the inequality data shows.
And how did this play out in terms of wages? The numbers you mentioned earlier were stark.
They really are dramatic. Between 1981 and 2018, look at the shifts. The top 1% of earners saw their share of total wages go from 10.7% up to 16.3%.
The big jump for the top.
Huge. But look at the other end. The bottom 50%. Their share dropped from 18.7% down to just 11.6%.
Wow. So they went from earning nearly twice the share of the top 1% to earning significantly less than the top 1%.
Precisely. Think about that ratio shift. 50 people used to collectively earn almost double what the single person at the top earned. Now, those 50 people together earn only about 70% of what that one person earns. It's a fundamental reordering of who gets what from work.
A massive shift in relative earning power. And the Gini coefficient reflects this too, right? Especially after corrections.
Yes. The Gini coefficient, that measure of inequality from 0 to 1, where 1 is perfect inequality, tells a similar story. The raw census data already showed it rising in Hong Kong, but the corrected estimates using tax data show a much sharper increase.
How much sharper?
Well, for 2016, the raw census Gini was 55.5%, already very high, but the corrected figure jumped to 60.8%. That upward revision is significant, suggesting official figures might have actually underestimated the true extent of wage inequality, especially recently.
So the gap was even wider than it first appeared?
It seems so, and connecting this to the bigger picture, the why behind it is fascinating. The study tried to break down these changes. They looked at the composition effect, basically. Changes in who makes up the workforce, like demographics, education, skills.
How did that play out?
That effect was inequality enhancing, meaning changes in the structure of the workforce itself pushed inequality higher, maybe more lower-skilled service jobs, fewer middle-income manufacturing jobs, demographic shifts. Things like that.
Okay, so the changing types of jobs and workers increased inequality. What about pay for specific skills?
This is the surprising part. Changes in the price of skills, what they call the wage structure effect, actually seem to reduce wage inequality slightly.
Really? So returns to education or specific skills became more balanced.
That's what the decomposition suggests. So even if the reward for having certain skills became a bit more equal, the overall mix of jobs and workers in the economy shifted in a way that drove aggregate inequality up. It's complex, not just about individual skills, but the whole structure of the labor market.
Fascinating. So structure trumped skill prices, in a way. But wages are only half the story. What about capital's role in Hong Kong? You mentioned its share exploded.
Exploded is the right word. It reached levels that are really unparalleled globally. Hong Kong's capital share, the slice of the national income pie going to owners of capital versus workers, is substantially higher than other high-income economies.
How high did it get?
After the Asian financial crisis recovery, it surged. From 32% in 2001, it shot up to 53% by 2012. Just think, by 2010, Hong Kong's capital share was more than twice as high as France's. That's an incredible shift towards capital income dominating the economy.
And that leads directly to wealth concentration, which you said was globally unmatched. Just how extreme is it?
It's genuinely extraordinary. The wealth held by the absolute very top, the top 0.001% of the population is now at the very top internationally, higher than pretty much anywhere else. And it's increased substantially since the late 80s.
Can you give us a sense of scale?
The paper's figure 8 is striking. It shows Hong Kong's top 0.001% wealth share bouncing around 60–70% of national income. That just dwarfs other major economies like the US, France, Sweden, even mainland China. It's a real outlier, suggesting an almost feudal level of concentration at the very, very top.
And that's based on rich lists, so it might even be an underestimate.
Exactly. They rely on Forbes lists and make assumptions like 5 adults per billionaire family to estimate individual wealth. They state this provides a lower bound, so the reality could be even more concentrated. And that kind of concentration obviously has huge implications for power.
This dive into Hong Kong really drives home how these economic numbers aren't abstract. They have real consequences for society, for politics.
Absolutely. This extreme economic divide has clearly fueled widening political cleavages. You see major splits between political parties and camps. As an inequality worsened, so did public discontent, especially among younger people priced out of housing and opportunities.
Leading to the political divisions we've seen.
It's a major contributing factor. You have the pro-democracy camp pushing for universal suffrage, arguing the economic system is unfair, partly because the government isn't truly accountable. And you have the pro-establishment camp emphasizing stability, aligning with Beijing and the business elite. The economic imbalance feeds directly into these deep social tensions and political conflicts that have defined Hong Kong's recent years.
Okay, from the intensity of Hong Kong, let's shift now to mainland China. A totally different scale, a different political system, but also undergoing this radical economic change. What did the Piketty, Yang, and Zuckman paper find there?
China's transformation since 1978 is just staggering. One of the biggest economic stories ever, really. The headline number, the aggregate national wealth to income ratio. It went from 350% in 1978, just before reforms really kicked off, to 700% in 2015.
It doubled. The entire country's wealth relative to its income doubled.
Doubled in less than 40 years. That rate of wealth accumulation is just unprecedented for such a massive country.
How'd that happen? What drove that?
It was a potent mix. First, just incredibly high saving and investment rates for decades. A huge chunk of China's income was plowed back into building things, factories, infrastructure, housing, sheer volume of capital accumulation.
Okay, saving and building. What else?
Second, a significant rise in relative asset prices. The value of things like real estate and company shares went up much faster than general inflation or incomes. And crucially, the paper notes this was underpinned by fundamental changes in the legal system of property.
Ah, so the rules changed.
Big time. Things like gradually lifting rent controls, introducing and strengthening private property rights for land use, for housing, and shifts in power between landlords and tenants, shareholders and workers. This new legal framework basically enabled and incentivized private wealth accumulation on a massive scale.
So it wasn't just growth, it was a change in ownership structure.
Yeah.
How did that balance between public and private property shift? Because China started as overwhelmingly state-owned.
It's one of the most dramatic shifts you could imagine. Public property share in the national wealth just plummeted. It was around 70% in 1978 when the state controlled almost everything. By 2015, it was down to about 30%.
Still higher than many Western countries, but a massive drop.
Exactly. 30% is still a lot higher than in rich countries, where public property is often near zero or even negative, but it represents a monumental move away from collectivism. And correspondingly, private wealth just surged, mainly housing and domestic company shares. The charts basically show private wealth rapidly overtaking public wealth, a complete flip.
So massive wealth growth, huge shift to private ownership. What about income inequality within China during this period?
This is where Piketty and Yang's work provided that sharp upward revision of the official estimates. They found inequality rose dramatically. The top 10% income share went from 27% of national income in 1978 up to 41% by 2015.
And the bottom.
The bottom 50% share dropped from 27% down to just 15%. So the top 10th now gets nearly 3 times the income share of the entire bottom half of the population.
How does that compare globally?
That's the really striking comparison. They found China's inequality levels, which used to be close to Nordic countries back in the late 70s, are now approaching U.S. levels. A huge swing from relative equality towards high inequality in just a few decades.
That's a massive shift. But, and this seems crucial for China, this happened alongside incredible overall growth, right? Even the bottom saw gains.
Absolutely critical context. And this is a key takeaway for you, the listener. Yes, relative inequality soared, the gap widened. But the whole economic pie grew so fast. The income of the bottom 50% in China was multiplied by more than 5 in real terms between 1978 and 2015.
5 times richer, even if their share shrunk.
Exactly. Compare that to the U.S. over similar periods, where the bottom 50% saw income stagnate or even fall in real terms. This absolute improvement for hundreds of millions of people in China, lifting them out of deep poverty, likely made the rising inequality much more acceptable socially and politically.
Because everyone was getting significantly better off, even if some were getting fantastically better off.
Precisely. When you start from very low living standards, and everyone sees tangible improvements year after year, better housing, more food, more opportunities, the relative differences might be tolerated more than in a stagnant economy where only the top gains. It really raises that question. Is inequality perceived just relatively, or does absolute progress matter just as much, or even more for social stability? China suggests absolute gains are hugely important.
A fascinating point about perception and acceptance. What about the overall wealth distribution now in China? Is it looking more like the U.S.?
It's getting closer. China's private wealth share, around 67% in 2015, was getting close to that of the United States, 72%, and already much higher than in a country like France, 50%. So in terms of who owns the wealth, it's rapidly converged towards a typical advanced capitalist economy structure, despite the political system.
And they mentioned Tobin's Q. What's that tell us?
Yeah, Tobin's Q is basically the stock market value of companies compared to the cost of replacing their physical assets. China's ratio appears high, similar to the US and UK. A high ratio often suggests investors are optimistic about future profits, maybe due to strong brands, good management, or market power things beyond just the physical stuff. It hints at a dynamic, market-oriented valuation system taking hold, though the paper notes more research is needed to fully understand it in China's context.
This deep dive really does show how economics is about peeling back layers, doesn't it? From these big, almost philosophical theories down to specific policies about zoning or legal changes in property rights and how it all connects to politics.
Absolutely. The story of inequality we've traced today really evolved. We started with Piketty's powerful, if debated, RG, but then we saw how empirical work, including his own, revealed these much more nuanced real-world drivers.
Like the huge impact of housing regulation, that high regulation tax, especially somewhere like Hong Kong. It's not just abstract capital, it's specific policy creating specific outcomes.
Exactly. And then in China, seeing how fundamental shifts in the legal system, in property rights, completely reshaped the landscape alongside that incredible growth. It shows it's this complex interplay, capital, growth, policy, institutions, politics.
And it forces us to think about perspective, too. That point about China rising relative inequality, but massive absolute gains for the poorest. We can't forget how much material progress has been made, even amidst these widening gaps.
It's crucial. Remembering the starting point, the sheer poverty that existed, helps contextualize the changes. The bottom 50% in China seeing incomes multiply fivefold is a world away from stagnant incomes elsewhere, even if the gap to the top also grew enormously.
Okay, so let's quickly recap the journey we took. We started with Piketty's landmark book, Capital in the 21st Century, that whole RG debate, its impact, and how the thinking evolved.
Right, the foundation.
Then we dug into that surprising but crucial role of housing regulation, using Hong Kong as a stark example of how policy can drive wealth inequality through property values.
The high regulation tax effect.
We saw the result in Hong Kong, soaring wage and wealth inequality, and how deeply that's tied to the political divides there.
Economics feeding politics.
And finally, we looked at China's immense transformation, that incredible wealth growth, the shift from public to private property, and its own dramatic rise in inequality, but importantly, alongside huge absolute income gains for the majority.
A unique, complex picture.
It really shows how both economic theory and the real world are constantly shifting, constantly evolving.
It definitely keeps things interesting. Understanding inequality isn't a destination, it's an ongoing process of discovery.
Absolutely. Well, thank you for joining us on this deep dive. Until next time, keep digging for those insights.